back, viewers. Today we are going to cover net present value. We will use the June 2019 ACCA F9 question 32. In this session, we are going to cover only A, item 1. Let's start with the required. Required A, calculate the nominal present value of Pink Course investment project, 8 marks. Let's go to the scenario. Pink Co is a large company listed on a major stock exchange. In recent years, the board of Pink Co has been criticized for weak corporate governance, and 2 of the company's non-executive directors have just resigned. A recent story in the financial media has criticized the performance of Pink Co and claims that the company is failing to satisfy the objectives of its key stakeholders. Pink Co is appraising an investment project which it hopes will boost its performance. The project will cost $20 million, payable in full at the start of the first year of operation. The project life is expected to be 4 years. Forecast sales, volumes, selling price, variable cost, and fixed cost are as follows. Year 1, 2, 3, 4. Sales units per year, sales price, dollars per unit, variable cost, dollars per unit, fixed cost in $1,000 per year. Selling price and cost information are in current price terms before applying selling price inflation of 5% per year, variable cost inflation of 3.5% per year, and fixed cost inflation of 6% per year. Pink Co pays corporation tax of 26%, with the tax liability being settled in the year in which it arises. The company can claim tax allowable depreciation on the full initial investment of $20 million on a 25% reducing balance basis. The investment project is expected to have 0 residual value at the end of 4 years. Pink Co has a nominal after-tax cost of capital of 12% and a real after-tax cost of capital of 8%. The general rate of inflation is expected to be 3.7% per year for the foreseeable future. Required A, calculate the nominal present value of Pink Co's investment project, 8 marks. Let's do the calculation together. Now, NPV Pink Co. We'll start with workings. Working 1 will be sales. I'll be using Excel as nowadays the examination is now computer based. So we have years 1, 2, 3, and year 4. Then we will have selling price, we put 125, 130, 140, 120 in year 4. Inflated selling price. Now we are told that selling price inflation is 5% per year. So we have 5% per year as our inflation. Now, in year 1, what we'll do, we'll say selling price multiplied by 1 plus the inflation allowance to the power 1. That is year 1. Then we copy that formula across. Then we will have our sales in units. We'll put them in thousand. We have got 300, 410, 525, 220. Then we'll have our total sales. Now our total sales will say our inflated selling price multiplied by our sales units. Then we'll drag the formula across. We have our figures there. Now we go to our working 2, which is variable costs. Our working 2 is variable costs, and we are told that the variable cost is 3.5%. We'll copy the years down. Then we'll say variable cost per unit. We are given the variable cost per unit as 71 for all the years. We inflate this inflated variable cost per unit. We will say variable cost multiplied by, we open the bracket, we say 1 plus the inflation rate. Don't forget to lock that. Then we close the bracket to the power 1 for the first year. Then we copy the formula down. Then we will say sales. We copy the sales from the working 1. Total variable costs. Total variable costs, we say the inflated variable costs multiplied by volume, which is the sales. Then we copy the formula down. Then we go to our working 3, which is fixed costs. We copy the years. Then we say fixed cost per year. Fixed cost per year we are given as 3,000, 3,100, 3,200, 3,000. Then we inflated fixed costs. The rate for inflation for fixed costs is 6%. So we'll say fixed cost multiplied by, we open a bracket, we say 1 plus the inflation rate, we close the bracket, we say to the power 1 for the first year, then we drag the formula across. There we have our fixed cost. Then now we go to our tax saving. Now our tax saving will have the year 1 up to year 4. Then in year 4 we will have the cost of the machine is 20 million, in thousand is 20,000. The tax rate is 26%. So the total tax will be 20,000 times 26, which will be 5,200 for 4 years. Then in year 1 now we'll say 20,000. The tax rate still is 26%. Then we are told that depreciation is 25% reducing balance. So we'll say 25%. Now we'll say 20,000 multiplied by 26% multiplied by 25%. Then we get 1,300. Then for year 2, we will say 75% of year 1, as this is the reducing balance method. We say 75% of the saving for year 1, we get 975. Then in year 3, we also say 75% of year 2. We get that. Then in year 4, we get a balancing figure. So a balancing figure, we say the total amount of tax to be saved is 5.2. We less tax that is claimed in year 1, less tax saving for year 2, less tax saving for year 3. Then we get 2194. Then we get our tax savings for year 1 is 1,300, year 2 975, year 3 731, year 4 2194. Then now we are good to go to the net present value calculation. Now we say NPV calculation. We still have got our years. Year 0, 1, 2, 3, 4. Then we have our sales. We'll take our sales from our working for sales. Then we copy up to year 4. Then we have our variable costs. Coming from working number 2. we copy the formula across. Then we have our fixed costs coming from working number 3. Then we copy the formula across. Then now, if we have all of that, we get operating profit. Operating profit will be the sum of the sales less variable and fixed costs. If we calculate for year 1, we copy the formula up to year 4. Then we have got tax payable at 26%. Then we'll say minus 26% multiplied by operating profit for year 1. Then we copy the formula up to year 4. Then we have our tax saving. Our tax saving, we copy it from our working number 4. After our tax saving, we get our cash flow. Our cash flow will be the sum of operating profit less tax paid less tax saving. If we calculate for year 1, we copy the formula up to year 4. Then now we have to discount at 12%, the nominal rate of discount. We discount at 12%. We discount at 12%. For year, the discount rate, let's put the discount rate here. Then for year 1, we will say 1 divided by 1 divided by bracket 1 plus 12% to the power 1. That is for the first year. Then we copy the formula down up to year 4. Then now we get our PVs. Our PV, we say the cash flow multiplied by the discount factor. We get that. For year 1, we copy the formula up to year 4. Then we get the sum of the PVs. Sum of the PVs then we less the cost of the machine, which is 20,000. then NPV becomes 33. NPV becomes 33.338. That's our NPV. Now there is a shortcut for calculating NPV. Excel also has the NPV function. But take note of using this function. We say NPV as per the Excel function we say equals NPV. We tab. We have now to put the rate. The rate that we are discounting is 12%. Then we have to put the PVs. Then we have to close the bracket. We have also to add the cost of the machine. We also get the same figure there. We also get the same figure there as 33.338. Now, I advise that when doing the computer-based, we have to learn how to use our NPV function as it is quicker. It uses the rate and the cash flows and the cost of the investment. You don't have to go through discounting and getting the PVs. Thank you very much. Do not forget to subscribe to my channel.